Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have a great guest, but first, a quick thank you to our sponsor. The Real Estate Espresso Podcast is brought to you by International Coffee Farms. International Coffee Farms grows and sells specialty coffee in Boquete, Panama. They now have 11 fully operational coffee farms, and they are 100% sold out. They are accepting reservations for farm number 12. If the idea of owning a safe, diversified offshore investment is intriguing to you, check out International Coffee Farms at internationalcoffeefarms.com. That's internationalcoffeefarms.com. We are back. Here on the weekend edition, we interview notable people from the world of real estate investing. We have a great guest today, all the way from Tampa, Florida. He's an investor. He's a podcast host. He's just a great all-around guy. Welcome to the show, Kevin Bupp.
Thank you, Victor. Looking forward to spending some time here with you today.
So, Kevin, we've talked a few times on the phone. How did you get into your particular area specialty, which is mobile home parks?
Yeah, it's I'll try to condense the story, Victor, but I've been a full-time real estate investor for 19 years now, and started like a lot in single-family investments and transitioned into multifamily and commercial back in the mid-2000s, and then ultimately got drastically affected by the downturn in 2008 and lost a large portion of my portfolio, had to rebuild and start over again, and really did that in 2010, 2011 era, and really the mobile home park space was brought to me by accident, or I was introduced to it by accident. I enjoy meeting new people, and I was introduced by a mutual friend to a gentleman by the name of Randy, and Randy had owned mobile home parks in Florida, and I had lunch with him with no interest whatsoever in his niche, other than just to meet someone new and add to my network of folks. And I left that 2-hour lunch meeting with Randy with a new vision, new focus, and that was to go out and purchase a mobile home park, just to really either prove or disprove this niche that Randy spoke so highly of during that lunch that we had together. And here we are 6 years later, nearly 7 years later, and mobile home parks are the only thing that we focus on today. I do own some other investments outside of mobile home parks, but as a company as a whole, that is our sole focus. So we've been buying parks now for a number of years, and have communities in now 13 different states.
Mobile home parks come in all different shapes and sizes, everything from the little mom and pops to the ones that are very established, ones that are close to metro areas, ones that are rural. What's your particular area specialty? What's the sweet spot?
Yeah, sweet spot would be 100 lots or larger in size. We do look at some smaller secondary and tertiary market. Ideally, we're looking at the strength of the local economy. We want an area that's at least got 100,000 plus population in the metro. Again, that's a very small metro, but we want something that, an economy that's in high demand of affordable housing. So we want to know that the median home prices are, over $100,000, preferably over $150,000. And so we just want to know that there's a huge demand for our product. All of our communities today are family communities, so they're not age restricted like you might see in Arizona or Florida. And then the overall quality on a 5-star rating scale, we're going to fall somewhere in like the 2.5 to 3-star and above. So we're not looking at the really low end, rough around the edge trailer parks. We're looking at the communities that are in good locations, good school districts that again have a high demand for affordable housing. Something that we can go in and breathe new life into it and offer a very clean, safe, and quiet place for families to raise their children.
Some communities own some of the mobile homes. Some just focus on renting the dirt. What's your perspective on that?
In a perfect world, we wouldn't own any of the homes inside our communities, but Victor, as you and I both know, we don't live in a perfect world. And so lots of operators that we've purchased from in the past, they do subscribe to the rental model where they actually own some of the trailers, or maybe a lot, maybe just a few. And so typically when we acquire a community like that has rental trailers in its stock, we do operate them as rentals for typically a short period of time, but our ultimate end goal is to sell those homes using different creative strategies to an end buyer buyer, someone that's going to own the home, live in our community for a long time, so that we can get out from underneath the repairs and maintenance that are associated with owning rental units, which would be roof repairs, plumbing repairs, ACs and heating systems going out. And so, again, in the perfect world, we wouldn't own any homes, but we do at any given time. I'd say I don't know that number today, but I think we probably got about 150 or more rental units spread throughout the portfolio. Some of our communities have 0, and others we have 15 or 20.
So these are typically a rent-to-own type structure where someone's been living in it for a while and eventually will qualify for some basic financing in order to take ownership of it?
Absolutely. And then, we'll even lose money on a trailer. And what I mean by that is if we've got a home that we've acquired, that was a rental trailer, let's say it becomes vacant. Let's say that unit's worth $20,000. And we've got someone that comes in looking for something that they want to pay with cash, and they offer us $15,000. Typically, I know that once they own that home, they're not going anywhere anytime soon. We've got residents that have lived in our communities for 30 plus years. Homes very rarely ever get moved out of a park. And so I'll go as far as even losing a few $1,000s if that means I'm going to get someone that comes in and pays cash for it. So in a market to where we don't have a large demand from cash buyers, then we do something along the lines of what you just mentioned there. We'll do a rent-to-own, or what we call as a rent credit strategy that will offer them a very easy and affordable way to get into that home on a more of a payment structure and to where they can own it in 5 to 7 years.
I love that. When you're acquiring new assets, are you looking to do a value add strategy? Are you looking to do a turnaround play? Maybe a property's been neglected. Maybe it's got some deferred maintenance. What's the play?
It's really based on we kind of back into the types of deals that we ultimately acquire based on the types of returns we're hoping to hit. Again, Victor, if in a perfect world, if we could hit the double-digit returns that we currently hit by buying stabilized 4- and 5-star communities, we would do that. But that's not the case today. We typically have to get our hands dirty, roll up our sleeves, and kind of dig into more of a value add play. We're really good at it though, and we enjoy it. We look for the challenge, and again, we look for that upside as well. And so, again, to answer your question, we're kind of forced into the value add game because of the types of returns that we're ultimately hoping to achieve on the backside. We wouldn't be able to receive those or realize those types of returns that we do today by buying stabilized communities.
Folks that are looking to invest passively in mobile home parks, money comes in all different shapes and sizes. Money always has an agenda associated with it. And by that, I mean, sometimes money wants to be tied up for 20 years. Sometimes it wants to be tied up for 6 months or somewhere in between. When you're looking to attract investment in your properties, what kind of money are you looking for typically?
We're looking for longer term money. They're not building too many more mobile home parks today. In fact, it's the only asset class that has a diminishing supply. And so when we purchase something, we're thinking of the long term, 7 to 10 year, potentially longer hold period. That doesn't mean that we don't sell and that we haven't sold, Victor. But normally we are not sellers, but everything is for sale at the right price. And so that money is not a short term play whatsoever. So if you're going to get involved in us as a limited partner, then you should really be thinking about having your capital tied up for 7 to 10 years.
Are you creating enough value where you can maybe get an interim exit with a refinance or anything like that?
Absolutely. Yes. Yeah. Our goal is to, at least of our current funds that we have operating, and every time we open a new fund, we sometimes make slight changes to the structure of it. But our current goal with our 2 existing funds is to get our investor their initial capital contribution paid back within the first 5 to 6 years. You
mentioned you've got a fund model as opposed to investing in individual properties.
That is correct, Victor.
And is this crowdfunded? Is it the typical Regulation D 506 type fund? How have you put that together?
That is correct. It's a Reg D 506C, and so only accredited investors. And right now, we haven't done any of the crowdfunding sites. All of our investors have come from our own immediate network. I have met a lot of our investors through my podcast, but they are high net worth accredited individuals. And again, it's a Reg D 506C offering. And to speak to the fund, one of the main reasons we decided to go with a fund structure versus a deal-specific structure is that we do a lot of off-market, direct-to-owner marketing campaigns, and so our pipeline is always fairly full with new opportunities. And about I guess about 3 years ago, when we made the decision to actually launch our first fund, we had, I think 8 or 9 deals in our portfolio, and it looked like at least half of those were going to make it to the finish line, and right about the same time of one another. And it just didn't make sense from a legal cost perspective, from logistical perspective, to do individual syndications for each one of those. And again, we're very confident in our deal flow, and so we figured we'd utilize the fund strategy and the efficiencies of it to take down those deals. And then, as we grew the pipeline, as we went into the following year, we realized that was a better fit for us. We're not only doing 1 or 2 communities a year. Last year we bought 9 communities. Right now we've got a pipeline that's got about a $40 million value to it, and so we're steadily buying, steadily building that pipeline, and have new opportunities coming in all the time.
That's awesome. One of the challenges with the fund model, which looks like you've overcome, is that when you raise money for a fund and it's sitting in your bank account, it's earning zero until you deploy it. So that's one of the reasons why we've shied away from the fund model and elected to go, deal by deal, because you can't necessarily, when you're doing large projects, you can't necessarily predict the time frame that's necessarily going to close. But where you've got such a strong deal flow, that's wonderful. That's great, and it's a great fit to the fund model.
Yeah, I think that's where a lot of folks get themselves in trouble with the fund model as well. Is you've got to be overly confident in your ability to source deals, and in addition to that, we don't raise capital until we have a very stout pipeline, until a number of those deals are further along in the due diligence stage, and so we're not raising capital and then looking for the deals. Like the deals we're always looking for. We're always building that pipeline, and we go through raising in different tranches when we feel very confident in the timing of when a batch of properties are going to close. And so very rarely do we ever have capital just sitting around. At most, it might sit around for a few months, but never an extended period of time. And so we're a little different in how we operate our fund, but we feel like it's much more efficient and it's much more responsible for our investors as well.
Let's talk a little bit about the debt side. Mobile home parks is not an asset class that every lender in the nation will do. How have you found, and sometimes lenders tend to be local in their geographic reach. How have you managed to source the debt if you're now in 13 different states? Yeah,
it depends on the deal, but mobile home parks, when compared to other asset classes, especially multifamily, they do come with challenges as far as financing is concerned. Although over the last couple of years, lending has lightened up a little bit in the terms of Fannie Mae, Freddie Mac, they're in our space. They've dropped their criteria a little bit as well, whereas 4 years ago, they only used to lend on very high-end 5-star communities. Now they're very much into our space. And so as long as the deal size is over $2 million, the loan size, Fannie Mae, Freddie Mac are very much an option, as is CMBS lenders. And so lots of high-quality term debt available. And when you get below the $1 million mark, that's when you really have to start looking at a local or a regional size bank. That's where a lot of the challenges really come into play in getting financing. Lots of local and regional banks are very specific with, where the asset's located. Is it in their marketplace? Where's the borrower located? We're trying to shy away from that size because of the challenges associated with getting them financed. It's just a lot of legwork, a lot of energy, and a lot of efforts to go to getting those smaller deals financed. And so, but larger deals are not challenging anymore, Victor, whereas a couple years back, or when we first got into this space, every deal was challenging. In the instance where it's a very high value add play, we've been very fortunate and lucky to get a lot of owners to carry financing as well. I think that's one of the beautiful things about this space is that it's got a large percentage of aging population of owners, that a large number of them own these properties free and clear. And so they've got the flexibility a lot of times to carry debt in the event that maybe the bookkeeping wasn't the best, or maybe it's got a high vacancy where a bank's not really the right timing to get a bank or a lender involved. So we've been very lucky and very successful with getting owners to carry financing in those kind of unique situations where lending's just not going to happen for it.
Whenever you perform due diligence on a project, there's obviously the project itself from a financial perspective, there's the market, but you've also got to perform due diligence on the infrastructure itself. Many of these parks have aging infrastructure, PVC pipes that have been buried in the ground. Some of them might be near end of life. how do you assess the risk, so you're not facing a $300,000 plumbing bill because you got to rip up and start again on the plumbing?
Yeah, we get professionals involved. I mean, we get plumbers in there. We'll dig up, sections or areas so we can see the pipe, see the age of it. We'll do sewer cams, throughout the entire park to see the construction material and also the condition that the sewer lines are in. Same thing goes with electrical. If we feel the need, we'll get an electrician out there to assess, or an engineer to assess the condition of the power poles and the actual breaker boxes on each one of the units themselves. And so, I mean, we get professionals involved. I mean, we're very knowledgeable ourselves, but we don't rely on ourselves when it comes to very niche expertise, such as plumbing and electrical infrastructure.
I love what you're doing. Well, you've managed to put together a very successful model. I know a number of your investors, and when you network with people and you build relationships, you often hear the back chatter, you hear the rumor mill. And when it comes to your projects and your properties, I'm not hearing anything that would give me any cause for concern. So that's, congratulations for that.
Yeah, I appreciate that, Victor.
And that's important. That back chatter happens, and we have to acknowledge that it's part of the ecosystem. And when it's absent, that's a great thing. It's not something that happens by accident. You've done a lot of hard work to put this together. So congratulations for that.
Thank you.
If folks want to get in touch, what's the best way?
2 different ways you can get in touch with me. My website, kevinbupp.com. It's also where I host one of the 2 podcasts that I do on a weekly basis. You can contact me through that website, or our company is Sunrise Capital Investors, and the website sunrisecapitalinvestors.com. You can learn a little bit more about our business, our mobile home park fund model, and also contact me through there. So I'm not too hard to track down.
I love that. So that's kevinbupp.com. So that's BUPP with 2 P's.com.
That's correct.
So definitely reach out to Kevin if you're interested in the mobile home space. He's a real expert at it. In the meantime, folks, have a great rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.